Good morning, everyone. Thank you all for being here. And I want to thank Tiffany, our speaker this morning from FASB, for being here. Just a reminder to make sure that you all pay attention to the polls that are launched throughout the presentation. The one CPE credit will be awarded. Just make sure that you oh my goodness, I'm at a loss for words this morning. Make sure that you just click that you're here for those polls. So we'll get started. I'll introduce Tiffany Wyszkowski, who's with FASB. She joined FASB in January of 2022. She's currently a project manager. Tiffany works on projects related to the 2025 agenda consultation, crypto assets, insurance, and disaggregation of income statement expenses. Prior to joining FASB, Tiffany was a senior manager at Deloitte & Touche, where she provided audit and advisory services to large global public and private companies within the financial services industry. Tiffany does hold a bachelor's degree in accounting from Siena College and is a New York CPA. So Tiffany, you have the room.
Wonderful. Thank you for the welcome. Let me share that. Okay. And if anyone has questions as we're going, feel free to ask them. I'll do my best to monitor the chat. If not, we have time saved at the end for any questions that you may have. And before I get started, let me read you our standard disclaimer, which is any views that I express today are my own and not those of the FASB staff or board members. Official positions of the FASB are only reached after extensive due diligence and process. So we have a jam-packed schedule today. So I plan to walk you through things that are on the current agenda. So whether that's the research agenda or the technical agenda, we'll go through some select projects there. We'll also talk about some ASUs that were issued recently. We'll cover off ASUs that we expect to issue by the end of the year. And then we'll talk a little bit about the Private Company Council, which is our advisory group that we interact with regularly to discuss private company issues. And like I said, if you have any questions, feel free to ask them as we go. If I miss them in the chat and you want to just, I'm assuming you can turn on your mics, feel free to do that. We'll go from there. Okay, so if you've looked at our technical agenda recently, you've probably seen a lot of projects are going to be finalized by the end of the year. But I thought before we jump into what's the technical agenda, I think it's always important to sort of level set what's the difference between the technical agenda, the research agenda. We can talk a little bit about what the EITF's agenda looks like and somewhat post-implementation review projects. But in order for a project to become a standard, typically the project starts on the research agenda. So the FASB chair, Rich Jones, maintains the research agenda. And this is where we perform research to understand if there's a pervasive need to do standard setting on that topic. And then in order for a project to be added to the technical agenda, the board has to vote on that. We have 7 board members, 4 of which have to vote to move something from the research agenda to the technical agenda, and sometimes we skip right to the technical agenda. So only projects on the technical agenda can result in standard setting. So when considering whether to add a project to the technical agenda, the board evaluates potential projects against 3 criteria to ensure that there's a consistent agenda prioritization decision. The first criteria is if there's identifiable and sufficiently pervasive need to improve gap. So in other words, what are the improvements that are needed? What are the extent that those improvements impact users, preparers, auditors, and other individuals that gap is applicable to. And the second criteria is whether there's a technical feasible solution, and what are the expected benefits of those solutions? Because we don't want to do something that's so costly that the benefits really don't outweigh the cost. So we look at a variety of alternatives and try to focus on the one that is expected to, be the most cost beneficial. And then finally, the board considers if there's an identifiable scope. So simplistically, what would the project look at? Because if we can't identify a scope, we shouldn't waste our time in doing standard setting. So those are the three criteria that they go through every time when they consider what to put on the technical agenda. And once it's on the technical agenda, we enter the deliberation stage. And this is where the board makes a series of decisions at one or more public board meetings about what potential changes might be made to GAP. And then once that phase has been completed, we issue an exposure draft, sometimes called an ED, for public comment. And it's typically out anywhere from a very short period of time, I would say 10 to 15 days, to sometimes 6 months. And during that time, we ask stakeholders to comment on a series of questions and let us know what they think about the proposed ED. Once that comment period ends, the staff and the board will analyze all the feedback, and during that phase, the board will also revisit all of the decisions they made, plus consider if there's any subsequent changes that need to be made to the exposure draft, which then, once they make all those changes, we then issue a final ASU. And once we issue the final ASU, we enter, what we could call like a support phase. So sometimes, while we think the standard should stand the test of time, we know that it doesn't always, because sometimes we miss something when folks are starting to implement. We need to make an enhancement to the standard. So that really goes on after we issue the ASU, and this happens for all ASUs. Sometimes it's broader, like you will see for post-implementation projects such as CECL and leases. Those are broader because those are bigger projects. So the first box on this slide is the technical agenda, and as you can see, many projects we expect to issue final ASUs before the end of the year. Many of these projects are a result of the 2021 agenda consultation. So if you've been following the FASB over the last few years, you'll know that we issued another agenda consultation in January of this year. We call that the 2025 agenda consultation. And we issued that in anticipation of many of these projects going final by the end of this year. So really the 2025 agenda consultation was our way of asking stakeholders, what should we work on next? So we'll talk a little bit about that in today's discussion a little bit later. The research agenda, which is the second box we have on this screen, many of these topics are also a result of that 2021 agenda consultation. However, if you had a chance to look at the 25 agenda consultation, you'll know in chapter 8 that we asked a number of questions about these research projects and the path forward on many of those. So I would expect the board to consider that feedback shortly and decide, if any of these projects should move from the research agenda to the technical agenda. And just to highlight a couple of those topics, if you've been following along, the statement of cash flows projects, both on the technical and research agendas, haven't really moved a whole lot. So the technical agenda project is more targeted at improvements to banks, where preparers and investors said that the current statement of cash flow is not decision useful, while the research agenda is more broad and more broadly impacts many entities. And that's focused on, are there ways to simplify the statement of cash flows, to make it more decision useful, and to reduce the restatement issues that have been observed in practice? As you can imagine, the statement of cash flows, while it's on just about every set of financial statements that get issued, it's a very difficult project to scope because there's so many opinions on what should be done. Should it be broad? Should it be narrow? So that's been a hard one for the board to kind of figure out how to move forward with. So we did ask some questions on that in the recently issued agenda consult. As it relates to derivatives, there's two projects on that, one on the technical and research agenda. You can expect a final ASU on derivatives to be issued, I think later this month we're targeting. That's more on simplification and some clarification of derivatives. And then the research project is asking, are there more things that need to be done on derivatives? We know it's a hard topic, but just trying to understand if there's more on that. The consolidation project on the research agenda was initially intended to explore a single consolidation model. Not a lot of progress has been made there either over the past couple of years. We have received a significant amount of feedback in the agenda consultation that was issued in January. I would say that feedback is mixed on whether stakeholders want to support larger changes to the consolidation model, while others support narrower changes. So I expect the board to have a pretty fulsome discussion on that in the near term. Hedging, we have two projects on that, one on the research and one on the technical agenda. The technical agenda project is very narrow and some targeted improvements, where the research project is broader. you have familiarity with hedging, there's a lot of questions and a lot of stakeholders have targeted requests to make fixes to the hedging model. And we've been doing that over the last, I don't know, 10 plus years, and maybe even longer. And I think we've started to ask ourselves internally, are there fundamental changes needed to the hedging model? And, what is hedging being used to today? So staff is currently developing a preliminary review document, which will ask stakeholders about, what's the purpose of the hedging model. Also, I think we're going to propose some different types of hedging models, get feedback on that. So I think you can expect to see that out sort of winter, early spring timeframe. If you're interested in that, please make sure you comment. And then finally on the research agenda is a digital assets project, which is our newest research project. That was added in the last month or so by Rich Jones, our chair. And this was anticipation of agenda consultation feedback, but also there's been a lot of feedback in the crypto space in general. I think if you've been following that space, you know that the presidential working group asked the FASB to look at some crypto topics. So that research project is targeted at looking at crypto lending and the accounting for stable coins, and if stable coins are cash equivalents. So more to come on that. And just as a reminder, we issued a crypto ASU in 2023 and the subsequent measurement of crypto assets. And there was a package of disclosures. So crypto assets that are in the scope of that ASU are now going to be accounted for at fair value. That's effective for companies with 2025 calendar year ends this year, both public and private companies. And then the third box in this slide is the EITF agenda, or the Emerging Issues Task Force, which as a result of the 2021 agenda consultation, that was reconstituted with new membership and operating procedures to enhance the efficiency and interpretive process and more effectively utilize the membership of that group. So that group tends to look at some very narrow targeted improvements. The EITF, how that process now works is the EITF will come up with recommendations on a path forward for a project, and they'll recommend that the board add it to its technical agenda, at which point the board then analyzes that feedback from the EITF and decides if an ED should be issued. So on the technical agenda, we have two projects that are a result of the EITF this year. So the accounting for debt exchanges and the measurement of paid in kind dividends on equity classified preferred stock are two of those projects. Just quickly, the accounting for debt exchange project issued a proposed ED earlier this year, which basically summarized that exchanges of debt instruments would be accounted for as new issuance of new debt obligations and extinguishments if certain conditions were met. That team just finished redeliberations with the board over the last, I think it was actually a couple weeks ago. So you can expect that ASU to be issued as early part of next year. And then we'll talk a little bit about the paid in kind dividends project in a little bit. And then finally, there are two post-implementation projects in which the staff is evaluating if the standard, which has now been implemented by companies, accomplishes the objectives of the board. The leases team just hosted a roundtable, I think it was on Friday, to solicit feedback on how the implementation of the leasing standard went. You can expect a board meeting in the near future on the results of that meeting. And I think also probably typically when we host the roundtable, we're starting to wrap up that post-implementation review process. So that's just a little bit on the technical agenda. We will dive into specific topics as we move along. So before we move along onto some topics, I thought we should also talk about the Private Company Council, which I suspect probably a lot of you work with private companies or are private company accountants. So we'll dive into that in a bit of detail. So on this slide here, we have some background information on the Private Company Council, or the PCC as we call it, which is our primary advisory group on private company matters. So the PCC uses something they call the Private Company Decision-Making Framework to advise us on the appropriate accounting treatment for private companies and projects that we have on the technical agenda. The PCC also advises us on possible alternatives to GAAP to address, the needs of users of private companies, but also manage the costs that are associated with implementing new accounting standards. There's currently 12 PCC members, and they have backgrounds as preparers, practitioners, and investors. And the chair of the PCC is Jerry Schauber. He's been our chair since 2024, I believe. We typically hold at least 4 PCC meetings a year. They tend to go 1 per quarter. Our next one coming up is next Thursday and Friday. And that will also include a joint meeting with the AICPA TIC committee on Friday. Portions of those meetings later next week will be live streamed. So if you're interested, you can always log in and watch any meeting that we're hosting live on our website. And we do host all board meetings live, and a number of our advisory committees are hosted live. So you're always welcome to log in and watch those if you would like. In addition to advising us on the technical agenda, the PCC also has its own technical and research agendas, and they recently led a project related to the measurement of credit losses on accounts receivables and contract assets that we'll cover in a bit of detail shortly. And if you've ever had the pleasure of logging into one of our meetings or reading one of the summaries with the PCC, you'll know that they talk about just about all the topics on the technical agenda that impact private companies. So at the upcoming meeting next week, you can expect us to talk a little bit about the accounting for debt exchanges. So the anticipation of the ASU coming out, PCC research agenda projects on leases, and also the leases PIR project. We will talk a little bit about the 2025 agenda consultation process, and we'll also talk about the results of the invitations to comments that were issued late last year on KPIs and intangibles. That's just some of the topics being discussed next week. In terms of outreach that the PCC does, they have regular discussions with private company facing organizations. Like I mentioned, they're going to talk to TIC next week. They were also out in Vegas earlier this summer, where they participated in the AICPA Engage conference. They're also always looking for more interactions with private company facing organizations. So if you're ever interested, or you see a need for standard setting, please feel free to reach out. You can either reach out to us, or we can connect you over to the right people in that group. Earlier this year, the PCC did issue their first ever report on the results of 2024, what they did. So if you're interested, it's on our website, you can read that. But also the PCC weighed in on 15 projects that we had on the FASB technical agenda last year, and they also made progress on 4 of their own projects. So yeah. Oh, and before I move on, I did want to highlight, and I forgot to mention on the last slide, the PCC also does host a couple of webcasts throughout the year that highlight standards that are coming down the pipeline that impact private companies, or standards that are becoming effective that impact private companies. In terms of the PCC's agenda, earlier this year, they issued an education paper on the presentation and disclosure of retainage for construction contracts. This is an education paper, so it just clarifies the current presentation and disclosure requirements in GAAP about retainage for construction contractors. It also provides example voluntary disclosures that an entity could provide that would provide more decision useful information to investors or users of your financial statements. So the PCC is currently performing research on a debt project related to subjective acceleration clauses, and in trying to determine if there's a need to clarify the guidance of when those debt instruments should be current or non-current on a classified balance sheet. They're also working on an interest method project and looking at some lease accounting simplifications. So we're going to start off with a project that was recently issued that relates to credit losses for account receivables and contract assets. We're going to talk about the measurement side of that, if you will. And this project is a result of actually research that started with the PCC that was then referred to the board when it became that it's probably something bigger that impacts all companies and not just private companies. So that's how that kind of moved along in its journey. So stakeholders noted initially that identifying and analyzing and documenting the macro data that's required to do the CECL accounting that for short-term assets that can be often costly and complex. And stakeholders also noted that estimating expected credit losses for current accounts receivable and current contracts assets that are collected after the balance sheet date, but before the financial statements are issued, can require significant efforts, especially when there's been collection between that period of after the balance sheet date and when the financial statements are issued. And that can also be, costly and can result in a expected credit loss amount, which doesn't necessarily, it's not intuitive, if you will. So that was really the result of why this project got issued. In July, the ASU was issued, which introduces a practical expedient and an accounting of policy election, and an entity can either elect both or elect one or the other, depending on sort of some scoping requirements that we'll talk about. So under the practical expedient, an entity may assume that the current economic conditions do not change for the remaining life of the asset. This will simplify the current accounting requirements to develop a reasonable and supportable forecast when estimating expected credit losses for those assets within the scope of the amendments. It's also important to note that an entity is still required to consider differences between the economic conditions during the period over which the historical loss information was collected and the economic conditions as of the balance sheet date. So for example, if an entity determines that there are indicators of severe economic recession at the balance sheet date, it will need to consider adjustments to its historical loss rates for differences between the economic conditions during the period. Additionally, entities are still required to consider changes in customer-specific or borrower-specific information when evaluating if credit losses are needed. As it relates to the accounting of policy election, an entity is permitted to consider the subsequent collection activity to reduce the population of the outstanding receivables that it is required to develop as it estimates the credit losses. And an entity would begin by selecting a post-balance sheet date. So what they would do is you can either do it through the date that the financial statements are available to be issued, or you could pick a date between the end of your calendar year end and when it goes out. And you'll have to disclose that. The entity would then not need to record an allowance for those balances that are subsequently collected by the evaluation date, and the entity would then just age the remaining population that wasn't collected during that period. Furthermore, it's important to note that an entity is permitted but not required to update historical loss rates for the subsequent collection activity. In terms of scope, so based on stakeholder feedback received on the exposure draft, the board decided to expand the practical expedience to all companies. The board noted that issues identified by stakeholders primarily related to the application of topic 326 and to the specific assets, and not necessarily whether the entity was public or private. In contrast, as it relates to the accounting policy election, the board decided that public business entities would not be able to apply the accounting policy election, so it only applies to private companies. And this is because public companies tend to have a shorter reporting time period, and they also have interim reporting. So the board didn't believe that there'd be any cost benefit to that. And as it relates to the assets, to address stakeholder feedback on the exposure draft, the board decided that amendments should apply to current accounts receivable and current contract assets that are arrived from transactions under topic 606, which relates to revenue. I'm seeing a few questions coming in, so I'm just gonna see. Oh, okay, that's not for me. There's a question about the slides. I believe we can send the slides out. I will, I just need to double check with our group at the end to make sure that that's okay, but I do believe we can, or if there's a specific slide or something, just let me know. We can probably make that work a little bit easier too. Moving on to disclosures. The board decided to require 2 disclosures as it relates to the practical expedient and the accounting policy election. Entities are required to disclose the use of the practical expedient and or the accounting policy election. And as I noted earlier, for the accounting policy election, an entity will need to disclose the date through which they consider the collection activity. In terms of transition and effective date, the ASU is effective for calendar year-end entities beginning in 2026 with a prospective application. But if you're interested, you can early adopt the standard. And as of note, private companies that elect the practical expedient or the accounting policy election will not need to perform a preferability assessment. And this is to permit private companies to elect the amendments in any period after the effective date. So now we're going to move on to disaggregation of income statement expenses, or DICE, as you might hear it referred to often. And this was a project that I worked on as well. So it's been on the agenda in some form or another for over 20 years, with the most recent project starting in 2027. And we issued an ASU in late 2024 related to this. So I'm going to walk us through it. There's a lot of details here, so bear with me. I'm going to try to simplify it as much as I can, but selfishly, I'll admit we have some pretty good examples in the codification and the implementation section that I think kind of the high level, if you're lost, the implementation section of the ASU does a much better job at kind of explaining it in detail. We just simply don't have enough time to do all that today. But this standard will only impact public business entities. And the board expects that nearly all public companies will disclose more information at the interim and annual reporting periods about the components of the expense captions presented on the face of the income statement. The board issued this standard because investors have noted over the years that there's insufficient information in the notes to the financial statements on what are the components of the expense amounts presented on the income statement today. And if you think about the average income statement today, it tends to have one or two revenue lines, maybe a cost of goods sold line, and then probably a few other expense lines like selling, general, and administrative expenses, or SG&A, as I like to call it, much like the income statement that we have here on the slide. So investors have noted that this level of disaggregation is just not decision useful. So that resulted in this DICE project. So the amendments for DICE will require entities that are public to disaggregate in a tabular format in the notes to the financial statements any expense caption that contains amounts related to purchase of inventory, employee compensation, depreciation, intangible asset amortization, or depletion and amortization related to oil and gas producing activity. In the example we'll walk through today, Entity X identified it had a relevant expense amounts in the three expense lines where the boxes around it. So that'd be cost of products sold, cost of services, and SG&A. So on the slide, I know it's very busy, but bear with me. I'll walk you through it. And the good news is this is an example that's straight from the illustrative section of subtopic 22040 codification, which is solely related to DICE. And in this example, we're going to talk about the disaggregation of cost of products sold. But because I did allude that Entity X said that they had amounts in cost of services and SG&A, they would also have to disaggregate those. So in this example on this slide, Entity X identified that cost of products sold was a relevant expense caption because it contained amounts related to one or more of the relevant expense categories, which is the first green box on the slide. The update will also require companies to disclose in the table certain disclosures that already exist today. So warranty expense, which is the red box on the slide, is one of those items. And the board decided on this requirement as a way to reduce the residual population of other cost of products sold, which is our second green box here on this side. And then finally, the lines changes in inventory and other adjustments and reconciling items, which are in the gold box, are needed for this amount because there are purchases of inventory amount, and this entity decided to present their disclosure on a cost incurred basis. And when a company uses the cost incurred basis for amounts related to inventory, those amounts will include costs that are capitalized to inventory during the current period and costs that were directly expensed. So in order to reconcile the disclosure back to the income statement, you need the changes in inventory and other adjusting and reconciling items. And this is only needed if there's an inventory. So it's not needed if there's no inventory in that relevant line item on the income statement. And also for amounts related to other costs of products sold or other adjusting and reconciling items, an entity would need to provide qualitative disclosure describing the nature of those expenses in that amount. As it relates to selling expenses, this is also a requirement. So it wouldn't be required for the tabular disclosure, so it would be separate. An entity would need to disclose the amount of selling expense and its definition of selling expenses. And a company can, the board was unable to define selling expenses across industries. So this is one of those opportunities where entities can define selling expenses for themselves that is meaningful to their entity. And on the right-hand side of this slide, we've included an example of what this disclosure may look like. Again, in the illustrative section of subtopic 22040, we have examples of what selling expense disclosures may look like. And then the guidance, like I've said, is applicable only to public companies with calendar year ends beginning December 31st, 2027 in the annual reports. And then the disclosures will also be required starting in Q1 of 2028 on a go-forward basis. And companies can early adopt the amendments, and the standard requires prospective application, but there is an option for retrospective application. Now we're going to cover off on a couple of topics that we expect to issue final ASUs by the end of the year. And we'll start off with the interim reporting project, which is a narrow scope project intended to improve the guidance in topic 270, which provides guidance on interim reporting. And the objective of this project was to improve the navigation of interim disclosures and to clarify when the guidance is applicable. So currently, topic 270 does not identify or clarify when financial statements are required for interim reporting. The board decided to clarify that the guidance in topic 270 applies to interim financial statements and notes prepared in accordance with GAAP. It does not apply to entities that may provide less information. So as a result of this decision, the phrase interim financial information was removed from topic 270. So said differently, the ASU will not apply to entities that provide less extensive information than a full set of financial statements and notes in accordance with GAAP. An entity, so for example, if an entity provides just account balances or just certain financial statement elements or ratios, it wouldn't be within the scope of topic 270. There are three key changes to topic 270. One are the disclosures required by topic 270, then disclosures required by other topics, and then there's a disclosure principle. And in determining which disclosures to provide condensed interim financial statements, a reporting entity should start off by evaluating the list in 270 to determine whether a disclosure is required to be provided. Then you would have to look to other topics if there's what I like to call event-driven disclosure. So if it's just an event occurs during this period, you have to provide certain disclosures. And then after evaluating your interim disclosures, an entity should consider a disclosure principle to determine whether additional disclosures are necessary for the interim reporting period. So the disclosure principle would require companies to disclose events or changes that occurred since the last year end that have a material impact on the company during the interim period. The ASU is expected to be issued by the end of the year, and the amendments can be applied either on a prospective or a retrospective basis with early adoption permitted. The guidance will be effective for interim reporting periods beginning in Q1 of 2028 for public companies, and then a year later in Q1 2029 for all other entities. Now we're going to move on to the accounting and disclosure for software costs. The board is expected to issue this final standard that will make targeted improvements on the accounting for internal use software later this month. And as background, this project was put on the technical agenda based on feedback that's been received over the years, but also because of the 2021 agenda consultation. Stakeholders noted that the board should provide guidance that better aligns the accounting for how software is developed based on the current guidance. that stakeholders believed is outdated because the current way you develop software has changed since I think we issued the standard in 1980. The internal use software guidance is currently written in a sequential and prescriptive software manner, which I think we all know that's not how we do software updates today. It's much more iterative process. So that makes it very challenging to apply the guidance in 350/40 because the guidance in 350/40 is based on stages, which we know is just not realistically how software is developed today. So the board considered a number of different approaches for this project over the last few years, but on the basis of stakeholder feedback, it ultimately decided to pursue a targeted improvements on internal use software guidance. The ASU will update the internal use software guidance in a few ways. The first amendment is to remove all references to project stages, which will improve the operability of that guidance. And so it'll be neutral as to the different development methods that entities may use to develop software today and into the future. And the removal of stages means that an entity will begin to capitalize costs when management has authorized and committed to funding the software project, and when the probability to complete the recognition threshold has been met. These requirements are consistent with the current guidance. Additionally, the amendments will clarify that if there is significant uncertainty associated with the development of activities of that software, the probability to complete the recognition threshold is not met. And this is referred to as significant development uncertainty in the guidance. So the new guidance will require that an entity evaluate two factors to evaluate whether significant development uncertainty exists. The first is whether the software being developed has technological innovations that are novel or unique or unproven, and that uncertainty hasn't been resolved through coding and testing. And also an entity will need to evaluate whether it has identified significant performance requirements that are required but haven't been resolved. So an entity will be required to apply this significant development uncertainty to all software projects. However, the board noted that it expects the evaluation to be very straightforward for projects that clearly meet the capitalization requirements today, such as the development of a new ERP system. Also considering stakeholder feedback, the board expects the capitalization of internal use software costs generally will not change significantly for most types of software. However, for the development of software that is to provide cloud computing arrangements, the board does expect that the amendments will reduce in a decrease in number of software that is capitalized. Then just to cover some other recent redeliberation decisions, the board decided to clarify that the PP&E disclosures are not are required instead of the intangible asset disclosures, regardless of how the software costs are included in the financial statements. Other than that, the board decided not to make any changes to the presentation and disclosure for software costs, and the website development cost guidance, which had its own area of guidance, will now be incorporated into the internal use software guidance to align the two sets of guidance. In terms of transition and effective date, the amendment will be effective for all entities with annual reporting periods beginning after December 15th, 2027, with early adoption permitted. Entities will have three transitions approaches available to choose from. One is a prospective transition approach. Then there's a modified transition approach that is based on the status of the project and whether the software has been capitalized before the adoption, or a more traditional retrospective approach. The transition approaches are a bit unique for this project. So if this is a standard that impacts your company or your clients, please make sure you take a look at this ASU when it comes out later this month. Check to see. Now we're going to move on to a project that is one of my projects related to the initial measurement of paid in kind, or as I'll call it, PIK dividends and equity classified preferred stock. You can expect an exposure draft to come out later this month. And this is a project that is a result of deliberations by the Emerging Issues Task Force that then recommended the project to the board and was added to the technical agenda in spring of this year. For some preferred stock instruments, dividends are not paid in cash, they're paid in kind. And the issuer satisfies dividend obligations associated with these instruments either by issuing additional preferred stock or with the same terms as the original preferred stock security, or by increasing the original preferred stock liquidation preference. Other than with respect to the difference in the compounding terms, both payment methods are economically similar. And in determining the appropriate measurement of PIK dividends, it's important because recognizing those amounts affects the carrying amount of the preferred stock on the balance sheet, and it reduces the net income available to common shareholders, which is used as part of the earnings per share or EPS calculation. The guidance in GAAP today doesn't currently address how these PIK dividends should be initially measured. And as a result, practitioners have observed diversity in practice, with some entities measuring PIK dividends at fair value, some measuring them based on the terms of the preferred stock agreement, and then other entities doing a mixed model depending on whether the dividends are discretionary or not. Given this diversity in practice, the EITF deliberated this in the spring, provided recommendations for solutions to the board that we'll talk about on the next slide. The forthcoming exposure draft is applicable to all entities. However, we expect this to be more impactful to private companies because our understanding is that PIK dividends are more common at the private company level, especially in those companies that are ramping up to go public. And the board has decided to require the measurement of PIK dividends based on the contractual terms of the preferred stock agreement, including the stated PIK dividend rate. So for example, if a preferred stock agreement specifies that PIK dividends are calculated by multiplying the PIK dividend rate by the liquidation value of the preferred stock outstanding, an entity would initially measure the PIK dividends at that amount. And one additional item to note is that the proposed amendments is not intended to be applied to preferred stock that is classified as liability. So it's just those that are classified as equity. The board decided that the amendments should be applied prospectively with an option for modified retrospective application only to equity classified preferred stock that is outstanding as of the effective date of the final ASU. Sorry, that's not the final ASU, as of the initial application date. Under the modified retrospective application, an entity would be required to recast prior periods presented for PIK dividends recognized and would recognize a cumulative effect adjustment to equity as of the beginning of the period. So simplistically, you wouldn't have to go back and restate your financial statements for preferred stock that is no longer outstanding. It would just be those that are outstanding during your transition. The board also agreed that with the ITF's recommendation to permit early adoption at both the interim and annual financial statements that have not been issued. And we expect the ED to be issued later this month. It'll have a 25-day comment period. So if your entity is at all impacted by this, we would love to hear your feedback. Accounting for disclosures and intangibles. So the next couple of projects we're going to talk about are invitations to comments related to key performance indicators and intangibles that we issued end of last year. And you can expect to see discussions at an upcoming board meeting. But before we talk about them, I'd like to explain the purpose of an invitation to comment, just to kind of level set, because it's a little bit different than an ASU or an ED. So an invitation to comment, or ITC as we might call it around here, is a staff document which does not include any board member points of view. It's a more open-ended document. We tend to ask a lot of questions because we're seeking input on the direction of a project. We're also usually trying to identify what the issue is. We tend to issue these when we get a lot of feedback and a lot of diverse feedback on what the issues is. So these projects aren't on the technical agenda because they're not standard setting. They're on the research agenda. So the purpose of the intangibles ITC was to solicit stakeholder feedback on whether the board should pursue standard setting on intangibles. This ITC uses the term intangibles to include both intangibles recognized as assets in the financial statements and intangibles and related costs not recognized as assets in the financial statements. And the ITC is focused on the initial recognition of intangibles. The ITC asks questions regarding whether there's a pervasive need to improve GAAP, what intangibles the FASB should consider addressing, what potential solutions there are, and whether there are different accounting for intangibles. So I guess let me back up. There's currently different accounting for intangibles depending on the nature of the asset today. So for example, internally developed intangible assets are accounted for differently than acquired assets as part of a business combination, which are accounted for differently than assets acquired as part of an asset acquisition. So there's a question related to should those three types of accountings be synchronized? And then there's also, what information do users and investors utilize today or would like to have today that would assist in their analysis in determining how, an investor allocates capital. So the team received 43 comment letters from a variety of stakeholders. The initial feedback was that there's minimal support for a broad project on reconsidering the intangible guidance. There was mixed views on aligning acquired intangible assets with business combination assets. And then there was some support for enhancing disclosure requirements, specifically to private companies. They noted that additional recognition of internally developed intangible assets would be costly and may not be decision useful. It was also noted that the current accounting for intangible assets is generally fine. So I would expect there to be a board meeting in the coming weeks on this, which should be interesting to see what the board does with this, if they put a project on the technical agenda or if Rich decides to keep something on the research agenda and makes it more targeted. So financial key performance indicators or KPIs for business entities was the other invitation to comment that was issued late in the fall of 2024. The KPIs ITC is also a result of the 2021 agenda consultation in which stakeholders said that the board should consider a project. However, the respondents from the 2021 agenda consultation expressed a very diverse view on the nature, the extent of the perceived issues related to financial KPIs. And also there's mixed views amongst board members on how to address this. So there was a project added to the research agenda on this related to this. And in the ITC, it defines financial KPIs as financial measures that are calculated or derived from the financial statements or the underlying accounting records that are not presented in the GAAP financials. So for example, it would include things like adjusted net income, free cash flow, or EBITDA, which are things that you're probably used to seeing in companies' earnings reports today. But it wouldn't include non-financial KPIs like same-store sales or churn, as those amounts are not derived directly from the information in the financial statements or the underlying accounting records. The ITC asked also a few questions, such as if financial KPIs should be standardized, if so, which ones, if financial KPIs should be required or permitted to be disclosed in an entity's GAAP financial statements, if they were to be required, when, what types of entities should be required to comply with a potential standard there, as well as whether KPIs should be standardized by the FASB, or should we allow management to continue to define them as they do today? So the team received 37 comment letters from a variety of stakeholders. Generally, feedback was KPIs are regularly used across companies today. It was noted that they're not comparable across those entities that use them today because there's entity-specific adjustments, but some noted that the level of comparability was sufficient because management often uses this to tell their own story about the business, and they tend to do a decent job in helping reconcile this information. As it relates to private companies specifically noted that it's not uncommon, that it is uncommon for private companies to publish KPIs. There was also mixed feedback on whether or not they should be included as part of a potential broader project if the board was to pursue one on KPIs. And similarly, to intangible assets, I do expect the board to deliberate on this in the coming weeks. So I also think it's going to be interesting to see if the board moves forward with this and puts a project on the technical agenda. Let's see if we have any questions. I hope I can see that. Oh, okay. So we're going to move on to the agenda consultation from this year. So the 2025 agenda consultation. This is one of the projects I've been working on. So it's a process that we started undertaking last fall. And if you recall earlier, the slide that I had on the technical agenda, we plan to issue many ASUs from now until the end of the year on just about all the projects that are currently on the technical agenda. So during the second half of 2024, we started performing significant outreach with stakeholders to identify priorities for potential standard setting. We talked to over 200 stakeholders, which had backgrounds of investors, practitioners, preparers, and academics. The feedback that they provided us helped us shape the content of the January 2025 agenda consultation. And this asks a number of questions about the future of standard setting and how the board should shape the technical agenda moving forward. Since then, we've received over 120 responses from stakeholders, both in comment letters and outreach discussions on what potential projects the board should consider as part of the technical agenda and standard setting in the future. The next slide gives you some perspectives on where we are today. So the comment letter period ended in June. And if you printed out all the comment letters that have been received, we've received over 1,200 pages. And the feedback is voluminous and well thought out. So if any of you out there provided us a comment letter or contributed one, thank you. We're also still in the process of summarizing that feedback. As you can imagine, it's quite a lot of feedback with quite a lot of diverse views, but you can expect that to be presented to the board sometime this fall, a summary of all that feedback. And we also expect there to be a series of meetings where the board will analyze the feedback against this agenda decision criteria to decide what changes to make to the agendas. This could include changes that Rich Jones, our chair, makes to the research agenda. This could also include projects moving directly to the technical agenda. And once the board completes analyzing the feedback received, an agenda consultation report will be issued sometime probably next summer timeframe, early fall, I would suspect. And this will summarize how all the feedback influenced the board decisions as it relates to the technical and research agendas, and if standard setting's already been completed, because some projects might move faster than others. And to give you some perspective on the feedback is very diverse. For example, some topics like enhancing disclosures received mixed feedbacks, with investors requesting more disclosures across a plethora of topics, while preparers are saying there's more than enough information in the financial statements, and the board should actually revisit some disclosures like the level 3 roll forward disclosures or disclosures related to derivatives, because preparers don't believe they're meaningful, and we should get more feedback from investors on that. So that's kind of some diverse feedback there. While there is some consistent feedback. For example, we did get a lot of feedback on hedge accounting should be a top priority for the board to consider. But there, I mean, the feedback there is continuing to either make targeted improvements or doing a broad project. So that'll be interesting to see where that project goes. But overall, I think I would summarize that investors' priorities are focusing on enhancing financial reporting information, while preparers and practitioners' priorities are more focused on reducing unnecessary costs and complexities in GAAP. Those are just some high-level observations, but there will be more to come on that. In terms of resources, because I know I covered a lot of ground today, but we could talk about projects for days and days and days, and I don't think you want to hear me talk that much longer, but also we all have a day job that we do need to get back to. So I know I didn't cover every project, but also even the projects I did cover, I didn't go into the nitty-gritty details. So if you are interested, at FASB.org, under the header projects, and then if you click on current projects, you can get access to our technical agendas, and it'll show you the status of projects. So each project gets its own project page, and on there you can find recent board decisions. You can find any exposure drafts issued. If there are exposure drafts, are there any comment letters that have been received? Also have a little bit of progress update on what next steps you can expect there. And while you're on FASB.org, you also can find a plethora of other resources. So we have a number of education materials. We have a link to the codification tool, which a couple of years ago we made free. That's where all the guidance resides. You can also find past issues, ASUs, EDs, documents issued in 1971. We have everything on there. And then there are also information about upcoming meetings. So as I've mentioned a little bit throughout our discussion today, a number of our meetings are live, or you can watch past recordings. We keep past recordings up for about 90 days or so. And if the recording's not out there, we often have minutes and recaps issued that are quite detailed about what happened at those meetings. So there's a plethora of issues, a plethora of support out on our website. So please do check it out. So I think with that, I'll pause to see if there's any questions.
Hello, can you hear me?
Yes, I can. How are you?
Good, good. So, the news has it that Trump is trying to change reporting from quarterly basis to biannually. Has the FASB done anything about that?
Oh yes, through the biannual. So we don't prescribe how often you need to issue your financial statements. So it's actually the SEC that's the one that prescribes quarterly reporting for public companies. So that's just not in our purview.
And then thing about the expenses that you highlighted, one of the expenses that I was looking through the Edgar. And one of the expenses that was not highlighted a lot by companies was the bad debt expense. So I don't know if I need to add that to your list because it's clumped up in a large number, so you can't really tell what bad debt expense is.
Yeah, so I think you might be talking about the disaggregation of income statement expense project that I talked about a little bit
Yes.
earlier. Yeah, so when the board decided on the requirement of requiring disaggregation of purchase of inventory, employee compensation, depreciation, and intangible assets, they deliberated if other expenses like bad debt should be required, and ultimately, through outreach with various groups, it was decided to focus on those. And that was because we couldn't get consensus on some other expenses. However, in your tabular disclosures, this is my plug, you can always disclose more. So if bad debt is material and you want to break that out and explain it more, please do. Nothing precludes an entity from disclosing more information than is required. So I like to say the gap disclosure requirements are a minimum. And if you would like to disclose more because it tells your story, please do.
Thank you.
All right. Well, we've hit 10 o'clock. If anyone has any other questions, certainly you can send them to me. I can forward them on to Tiffany. Tiffany, thank you so much for being here this morning. That was a lot of information to take in. So this was great. Thank you, everyone. Have a great day. We'll see you next month.
Thank you.
Thank you. Bye-bye.